Welcome to Gold Silver Pros. Searching for the best precious metals deal? Shop with our trusted partner, 𝘎𝑗𝑃. Access special deals on silver, gold, and platinum through our website or call 307-264-9441.
You brought up some economic indicators, and I want to take a step back here and to talk about that, because silver, gold as well, by the way, has put in a run when the Fed, or when the market seemed to sense that the Fed might be pivoting, and that was around early November, right? That's when we started running. Gold ran from 1615 to close to 1900. I think it was even 1950, I think, at some point. But and silver went up to $24, sort of didn't break through that wall barrier. Mm-hmm. But a massive rally for both precious metals. Now that the inflation numbers are somewhat coming down, but they just jumped up again. You pointed that out in your last answer. The relationship between there is like, was the market, and you sort of said the market jumped the gun a little bit. Like, do you want to elaborate on that? It's like, help me understand it, like how silver and gold sort of move with those indicators. Because now the market is saying, well, yeah, we were wrong. Okay, let's sell it off again. Like the Fed is not pivoting, or it doesn't plan yet, or it might take an extra month. So I'm not sure why that thesis all of a sudden is flawed that we had before, starting in November. Because I don't think it's changed, in my opinion, but the market thinks it's changed now, and the market has done a complete 180.
That you nailed it. It's the market's anticipation of what the Fed may do that really drives what the market does, and the market tries to price it in ahead of time. That's why when you listen to mainstream media, they're always talking about, is this priced in? Is the market, have they already put it into their prices, into their economic models at the point at which we actually get to the decision, right? And a lot of times that happens, and the market will swing on that. Going back to my comments earlier, I do think that gold and silver jumped up a little quicker than I would have anticipated, because early numbers on Q4 here in the U.S. in terms of retail sales, and consumers are 72% of the economy. Retail sales were down about 1.1%. It looks like we've had a jump in January at 3%, which is good, although January is not normally nearly as retail heavy as the last 2 months of the year are in the United States. So it's good to see a little bit of a jump in January. It doesn't make up for the losses that we had the last 2 months of the year, November, December. So we haven't had the rosiest retail sales. We didn't have the rosiest fourth quarter. And what I said was gold and silver shouldn't jump until we get earnings reports out. And we're getting a tale of two things in the earnings reports. The majority of the S&P 500 is making a little bit of money, but there is about a third of the S&P 500 that's reporting negative earnings, and it's dragged the entire earnings report so far. Collective earnings, I think it's negative 4.3%, according to what I saw on FactSet. We put that on the program. So there's two-tier system right now. Some corporates are doing okay. A lot of them are doing very, very bad. And I think that's pointing to structural areas in the economy in which these companies are no longer doing well because the economy cannot support them. And I think if you take a broader look at the numbers, the economic numbers for the U.S. economy and even for the world economy, they're not great. High levels of debt, interest rates, things like that. Now, as goes inflation, deflation, I think we're in inflation deflation cycle. So I will defer over to 𝘎𝑃𝑗 Capital, who talks about this a lot. When you look at inflation deflation cycles, and he has great charts out there for anybody who's interested. If you look at inflation deflation cycles, the last one we had in the 70s, 80s, it had 3 rounds. It had inflation, deflation, and then a high blow off inflation before it got under control with the Fed. So right now, if that pattern resumes and that's where we're going, there's going to be a lot of back and forth between Fed policy, the economy, interest rates, and things like that. And so there could be a lot of traps along the way, both bull and bear traps about where the economy is going until we reach final resolution. And final resolution is, have we gotten enough of that misallocated capital out of the economy so we can resume on a growth path? I don't think that we have. And so I think there's going to be more cycles coming in terms of inflation versus deflation. I think it's going to cause problems with the supply chain. And I think the Fed is going to look a little schizophrenic here, because they may tighten more at times, they may tighten less at times. And I think they're going to be reacting to what's going on. And then the market's going to react to that. And so that, I think, is where you're going to get a little bit more volatility in asset prices, and in markets, more asset price swings as everybody's trying to figure out what's happening. But essentially what's happening is natural economic law is coming back into play. And some of the limits we've reached in our current system, we're reaching. And so we have to have resolution. We have to have resolution with this debt. We have to have resolution with the fact that we're not growing. we have to have resolution with the fact that our balance sheets, our internal balance sheets, need to get better, and that's at every level. That's at the sovereign level, the corporate level, as well as the individual level. And so I don't think sort of the tough times are over, but I do think there are pockets in there where things could look rosy. And so I think as it relates to economic data and gold and silver, you're going to see some fluctuations in price, and that's normal to expect in that market. And I expect this to go on maybe for the next year or two as well.
That's both banks and foreigners. Then thirdly, bank depositor risks, which we're going to get back to, about people who think that quote unquote money in the bank is in the bank and it's really theirs. So let's dig into each of those one at a time. So first, this thing, when the economy gets sick, the banks catch a cold. Can you talk to us about why it isn't an isolated incident? Yes, we know that when companies get in trouble and have to do massive layoffs, it hurts those individuals who had jobs. Now they no longer have jobs. That's clear. It's going to hurt their consumer spending, that sort of thing. It's going to hurt in their life. There's going to be pain. Some of them are going to lose their homes. We've been through that before. Recessions are painful. But talk to us about how that becomes a systemic problem or a systemic risk when it happens on a large enough scale that it actually starts hurting the counterparties as well.
Yeah, back in the olden days, before we had all this rapid globalization, after the industrial age, we went into this information age. We had a lot of globalization. We have exporting of our labor to other nations. We became the dominant nation state currency. And what happened there was we essentially exported our economy to other economies around the world. So now we're global and now we're intertwined. And if you look at the banking system now, done again, it's very incestuous, if you will. Everybody's investing in everyone. And one of the things that you can look at is something called foreign direct investment. When one country is investing in, or a company from one country, one region or domicile is investing in another, they're putting equity into it. So if that receiving country then comes into trouble, it affects the country that's investing. And now multiply that like a giant spider web, everybody to everybody, all different countries investing in everyone. Not single point to single point, but like a big web. Everything's connected. What happens is when you tug on one string on that spider web, all the rest of them feel that vibration. If you start breaking that spider web, the rest of the web can break down because it's a superstructure dependent upon each of its individual parts. And yes, you could take a single link and knock it out and the web may be okay. But if that turns into a contagion where everybody's kind of looking at it, then all of a sudden that web, that structure could fail, and then the web blows away and the spider's got to build a new one, right? That's kind of how the debt-based banking system is working. And the reason I think that people may think that this is global is because we're hearing bad news out of many economies. We're hearing bad news out of China, hearing bad news out of Europe, certainly. We've been hearing bad news out of Russia and Eastern Europe because of the war. And then, of course, you have the United States.
And Japan.
And that's become a really big issue. And one more point I wanted to bring to you, something I put on my channel last year. The Bank for International Settlements, or the BIS, tracks zombie companies. And you mentioned zombie companies. A zombie company is basically somewhat defined as either they can't make their debt payments or they can't function because of debt or lack of income. And so they can go for a while, they're zombies, up until they cannot get new debt to take care of the old one. It's kind of like a Ponzi system, if you will, debt based upon debt. When you can't get that next customer giving you debt, when they figure out the game's up, then that whole system collapses. Well, in that BIS report that I put on the channel last year, not only were there a higher percentage worldwide, not only in the US, but across the world of companies that were considered zombies by the BIS's criteria, the confidence interval they had that any of those companies could return to normal operations was the lowest it's been since they've been tracking it. So you're looking at going, not only is the rate of acceleration, or not only do we have more companies, but the rate of acceleration and the chance for them to redeem themselves is going down. And so all of a sudden, now you're thinking about, okay, how do we bail those guys out? And that's why all the laws around bail-ins went in place, I think, in 2012. And we can get into that in a moment as to how it affects your bank account and your individual assets within that banking system. And certainly now, if you own a bank account, you have counterparty risk. Then again, what's that counterparty risk? It's exactly what we're talking about. If Silicon Valley Bank tanks and that starts, a cascade, then all of a sudden your funds in your bank account can be used to bail that in. That's on federal law right now. It can be used to bail that in. And so it presents risk not only to the individual companies, but all companies that may be invested in it, all countries that may be buying that debt, any that buys that debt, as well as anybody that holds money in a bank that's used as assets. Because once a bank fails, then they're going to start looking at the deposits as an asset, right? And that's an issue because not everybody will be made whole. Everybody's going to take a loss at that point. And so it reverberates around the economy. It's not just the direct investors of that bank. It's anybody that may have held funds or have any business with that bank as well.
Let's talk about that on the foreign bondholders of the U.S., because when Powell keeps increasing interest rates, you said mathematically it has to depress the value of existing bonds. So all of these Treasury holders worldwide are sitting on these piles of U.S. Treasuries, and they're seeing the actions of the Fed, which now everybody thought maybe he's going to pivot, maybe he's going to taper down, stop doing that. But no, it's still marching forward with further increases. So can you talk to us about why foreign bondholders may be equally incentivized, not just these domestic banks trying to get out of their holdings, but foreign investors as well?
Yeah, foreign investors really don't like us right now. And I did an article recently where I looked at countries that were selling off U.S. Treasuries. Japan led the way. I think it was something like 270 billion last year. China was in there. There's a top 10 list of countries that are just simply selling debt. It's not only that they've stopped buying, they're selling. And that is putting additional pressure on the sovereign U.S. debt market, because it forces who to be the backstop for that? Well, the ultimate backstop is who? The Fed. Well, if the Fed is not buying what everybody else is selling, and they're in a quantitative tightening cycle, now you have no buyer of last resort. So without the buyer of last resort, how does that system survive? It becomes a big issue. And that's what everybody knows. As soon as the Fed started tightening, you basically, in this environment with such high debt, historic levels of debt, if you looked at debt to GDP, it was at 140%, I think, at one point during the pandemic. Now it's maybe 120, 125 in that range. It's still at an all-time high. And it's past, the danger zone. And so what happens is the world sees that and then sees the Fed announce, oh, we're going to tighten. And immediately then the wheels start turning in their mind. Oh, wait a minute. Interest rates are going to go up. That's going to affect the bond market. That's going to affect profitability of our current holdings. And if you look at China, for example, and Japan and nations like that, which have really supported us over the years in buying our debt issuance, Saudi Arabia, for example, in the dollar oil trade, all of those countries are starting to look and say, maybe this is not a trade that we want to participate in. And there's one more thing I'll add in there. When NATO and the U.S. took sides against Russia in that war, essentially that pitted NATO and the Western nations against the BRICS nations. So now you have this economic, political rivalry going. The problem is the people that we're rivals with happen to be our investors. And so now our investors in the nation aren't too happy with us right now. So it's just a perception problem right now, but I think it's manifesting in the financial markets.
Well, I believe it's more than a perception problem. It's basically putting sanctions against those who have been supporting you. So that's exactly. biting the hand that feeds you, essentially. And I skipped over, and I shouldn't have. If you could focus just a little bit longer, because this week we've seen a sell-off of major big-name American banks, not directly related to the SBC failure, but the commentary that's come out on that, we'll try to get a link and put it in the description of this video so people can look up that further, is that these major U.S. banks have been selling huge amounts this week of U.S. Treasuries at a loss. And you mentioned why their Treasuries would be down because of the raising interest rate environment. You'd think normally any holder of an asset would prefer to hold that longer until it gets a chance to recover, to be in the green, be above water before you sell something. But to sell something knowingly at a loss when you're underwater in that investment was theorized to be either one of two things, and you said perhaps both when we were talking. That is, either they see ahead, they go, oh my gosh, there's going to be more of the same. In other words, let's not wait longer here for the Fed to reverse course and drop interest rates so that the values of our bonds will recover so that we can sell them in the future. It's like, no, forget it. Let's dump these things now before it gets worse. And secondly, if they are actually acting out of desperation to raise liquidity to bail out their own solvency problems that are not acknowledged. Everything's fine. But meanwhile, yeah, we're liquidating assets at a loss that are supposedly the, U.S. Treasuries. That's supposed to be the most solid, most liquid asset you can hold on to outside of real assets. But anyway, so can you talk to us about what might be driving these major banks to sell off their bond U.S. Treasuries at a loss this week?
Yeah, if you go back to a point we had earlier about the easy money era since 2008, the last financial crisis, we started this thing called QE, or quantitative easing. And it's this ridiculous term that basically means we're going to issue a lot of debt and print a bunch of money. But we got to give it a fancy name so it seems technical, like the technocrats really know what's going on. But essentially what's happening is with all this QE, we just shoved this bazooka of money and debt into the system. And at some point, that system has to fail. And essentially what's happening is we got to the point at which we issued more debt in the system and it wasn't growing the economy. We started contracting. We started having negative earnings reports. And last year we had 2 consecutive quarters of negative GDP, but nobody wanted to call a recession. And the White House says, no, let's don't call it a recession. Employment's okay. We can talk about employment later and the farce that is. But in any case, nobody wants to admit the recession because I think that this is what they know. They know that the system is in trouble. And this has been played out before. I feel like I'm in the Matrix movie. You know, how many times have we gone through this and how many cycles do we have to go through? Essentially, everybody knows with the rising interest rate environment, the U.S. is not going to be able to maintain their stance towards repaying their debt. And I think as far as the individual banks go, the banks look at the Fed to see what they're doing. The Fed in this system, in this centralized monetary system, where we have the central bank controls, you know, the Fed funds rate, which hits the real estate market, hits a lot of markets through different mechanisms. You know, different treasury issuances will affect different of the markets here in the U.S. And so what's happening is a lot of markets are selling off. There's been pressure on real estate as well. There's been pressure on a lot of assets. And I think the world is looking at it going, we need to liquidate assets because no longer do we have, like I said, that next batch of debt to pay off the other one at a lower rate. We have that next batch of debt to pay off the older one at a higher rate. That's not favorable to our business. And so we've gotten to the point in which you can't get that easy money anymore. Well, when you don't have that easy money coming from the Fed, what do you turn to? Like, for example, if you're working and you lose your job, but you got to pay the bills, what do? You start selling stuff. You go to eBay, you sell your car, you may sell your house. You know, you got to do what you got to do to liquidate. And so a lot of these banks are looking at going, okay, I'm not going to be able to take on additional debt. And companies too. I think this is coming for companies too. Dunnigan. So banks are saying, I'm not going to get that easy debt. We're in a rising interest rate environment. The value of my existing holdings that I have for other people, remember, everybody's investing everybody else, is basically, it's going down. We know that we're going towards a recession. Everybody's saying it, you know, yield curve inversion, all of those things. So what are you going to do? If you have an asset and you're out of a job and you've got to pay the bills, you got to pay the rent at the end of the month, you owe $1,000. And you have, say, a really nice iPhone that you want to sell, you're not going to wait till the end of the month because what if it's worth less? You're going to sell now. You're going to liquidate as much as you can so you can pay that bill and you can stay in your home or your apartment, for example. That's what the banks are doing. They're selling off assets so that they can maintain operations so they don't go under because they know that the Fed right now is not backstopping that system. And that's essentially what's happening. And I think this is going to come to corporations next. A lot of these companies, if you look at the earnings reports for fourth quarter 2022, out of the S&P, I think almost 2/3 of companies were profitable. 1/3 were not. 1/3 had a loss. But that 1/3 drug the other 2/3 into negative territory. So net in quarter four 2022 in the S&P 500, the broad, 500 largest companies in the U.S., we actually had a retraction in growth, even though 2/3 of them were profitable, because the losses that we had in that 1/3 were so big that they overwhelmed the gains in the other 2/3. And that points to serious problems in the economy. And what was the biggest sector that got hit? Well, finance. Finance took the biggest hit in the fourth quarter earnings reports. And what we're going to start seeing in the next couple of months for those companies who haven't done this, as they go through their compliance with Sarbanes-Oxley and other things, or start getting year-end reports. And we're going to start seeing, January to December 2022, how companies did. And a lot of that is starting to come out negative as well. But it got worse in fourth quarter. So what we see is it was okay the first half of last year, then it started sliding down, then fourth quarter was kind of the worst. And then the question is, what about the first quarter of this year? Is the first quarter of 2023 going to be good enough to kind of save that system? I don't think so, based upon what we're seeing in the economy. So it could be that we are on sort of a slow slide down until we reach some sort of inflection point. That inflection point in the economy is when the Fed would have to make a decision to pivot from tightening to then easing, because if they don't, they could, they're worried about a crash, I think. And I think that's done again why they've been raising interest rates. I think they know, because if you look at the IMF and the studies that they have done, and these papers have been out for years, they know that when you go into a recession, that any central bank throughout history has to have at least 5 to 6 full interest rate points, a positive above zero, that they can then reduce and inject money back into the economy to get it started again. Well, what's the Fed's target? 5 to 5.25. They're hitting the IMF's target. They know what's coming. That's the single statistic that tells you they know what's coming. They're trying to get to that IMF threshold. They know the recession's coming so that they can then ease. But you can't ease too quickly. And along the way, you're going to have these banks and companies that are going to go out because they were in the weaker position. And the Fed knows this. They know that part of the economy is going to suffer in the tightening. What the Fed is thinking is we're going to stop the Titanic from sinking, right? So we're going to have to sacrifice some stuff. We're going to throw the furniture off and kind of, try to save it. I don't think they're going to be able to, but I think that's what the Fed's plan is.
So, Rob, we're recording this interview on Wednesday, March 22nd, 2023. The Fed just raised interest rates another 25 basis points. Some people are actually surprised by that, but by the narrative that they're fighting inflation, they're still sticking with that for the most part. Do you think that all these rate hikes now over the last 12 months or so, and there was kind of record amounts of them in such a short amount of time, do you think it's finally starting to break things?
Oh, yeah, I think it's broke things. I think you saw, a couple of bank failures directly related to it in the last couple of weeks. SVP, one of the original issues was that they had a bunch of treasuries that now the interest rates are up, face values are down. They needed, I guess, additional assets or liquidity. And their deposit holders got wind of it and took out $42 billion and basically bankrupted them. And the whole scheme with the banks, it kind of works like this. You put $10 in, $9 goes somewhere else, $1 stays there, roughly speaking. And when people want their money, they're expecting the $10, but they're only able to get the $1. The rest of it's out in the market. And that's how this system works. And when people made a run on those two banks, SVB, Silicon Valley Bank, and then eventually Signature, which is more connected with the crypto side of the market, those banks essentially had an insolvency event where they didn't have enough money to continue operations because, cash is cash, right? And that just highlights the problems with the banking system when there is a run on the banks or there's a need for liquidity. And all of that essentially comes down to there's so much liabilities in the system, debt liabilities, there's not enough cash to service them. So at some point, that model always breaks. It's basically a giant Ponzi. And when there's not enough free cash to service the debt, we have issues like this. Typically, it shows up in the repo markets. We saw that happen a couple of years ago again. And looking back at researchers' view on the Great Recession, 2008, 2009, there was a repo crisis. We just didn't know to look for it. But there's a lot of research on how that went down. We had that again, I believe it's like 2019. We started having repo market issues again. And the Fed had to step in and put some high quality, short-term treasuries out there to provide liquidity. And so short-term treasuries are basically akin to cash in the current system. They're not really, they're a debt, but they're traded as cash. And so sometimes you can kind of facilitate the system that way. But at the end of the day, we don't have enough cash for the debt. That's part of the issue. The other issue is the debt itself is taking a beating on valuations. And so that's causing essentially, this is the Ponzi system collapsing. When the debt revalues because people value it less because there's risk in the system, they think there's a recession coming, that's when that system starts to crack. And it'll show up in any of the liquidity markets, the repo, the cash markets is where you first see it because that's where people run to. They run to cash.
I think you present our listeners with some interesting insights there about the fractional reserve banking system. So you brought up U.S. Treasuries. They're also used as collateral too. So by the banks for all these leverage trades. So if a large bank like JP Morgan or Wells Fargo Bank or Bank of America or Citigroup wants to go in and do some of these crazy derivatives trades, they normally buy some type of U.S. Treasuries and post those as collateral. Well, those treasuries have been rehypothecated. And then often what you brought up with the repo market too is a lot of people are not aware of this, these money market funds. And I'm seeing all these posts under my videos too about why should I hold cash in a bank account when I could go put it in a money market fund at my stock brokerage or at any bank or something like that and earn around 5%. I'm dumb not to. Well, the average retail investor out there that's parking their cash now trying to earn those extra interest rates at a money market fund, they don't understand that the money market funds too are also loaning into repo, and that those were big problems in 2008, 2009, and also during the 2019 repo madness crisis. The Fed actually secretly bailed out those money market funds because they put in tons of cash into repo for overnight lending for repo. And then the banks that borrowed and the hedge funds that borrowed from repo, they couldn't pay back the repo loans, which means the money market funds were also at losses.
Yeah, and the problem with the money markets is in the 90s, they created something called a sweep account. So when you own a bank account, you don't actually own it. You own the account. When you put your money in a bank, it becomes their asset, and you become a liability to them, which means they own the cash, and you become a beneficial owner. So they manage like a trustee would your account, and then they're responsible for giving you equal value back. Well, in the case of like SVP and Signature, people that had over $250,000 got these certificates. And then it's basically like a bank share. But if the bank is not collateral, I mean, obviously, if the bank's going bankrupt and they're divvying out assets, if they give you a share certificate to the bank, what's that worth? It's not worth the paper it's printed on, or else I wouldn't have had issues in the first place. So what they do this sleight of hand where they say, well, we can't make you whole, so we'll give you this dead asset in the bank. In other words, it just forces depositors to take the loss. And so not only that, but what they've done with these two banks is they've said, well, we're going to finance this bailout of existing depositors with the FDIC insurance fund, and they just pass the fees on to the other banks. All the banks are going to do is pass it on to consumers. So consumers just bailed out these two banks essentially. And the conduit was the FDIC system. And it has to be that way because the FDIC only has slightly over a percentage in its insurance fund for all the deposits in the banks. So once you go over that, I think right now it's like 1.26. So once you go over that 1.26, their FDIC is insolvent. And then all they're going to be able to do is print money, essentially. But they're not going to be able to solve the banking system issue. So everybody's going to get haircuts. Everybody's going to get less. What was particularly interesting in the case of SVP and Signature was that typically in these bankruptcy type scenarios, the bondholders get first position or at least senior position to stocks. They'll get paid out first. But in this case, all the existing bond and shareholders of the banks were basically told you get zero. And they only were trying to ensure the depositors, and I think that's because they were worried about a run on the banks. If any depositor came out and said, I didn't get my money, or an assurance I was going to get my money, I think that would have been a huge run across the U.S. banking system that might have spread internationally because all the banks are basically invested in each other. So I think that the officials did what they thought was absolutely necessary. I think that they had to break some laws along the way and break some common practices along the way. And that tells me that they were particularly worried about this particular scenario, even to the point of where maybe they didn't expect it to happen. But to answer, I think, a question you asked, liquidity in the system is provided by the Fed. The Fed's been raising interest rates and even selling some of their paper into the market, which means instead of being lender of last resort and the backstop to the system, they're now selling into that system. And of course, that's going to cause, when you're hiking your Fed funds rate and most other products eventually, exist off of that rate, including like mortgages off of 10-year bonds and stuff like that. Yeah, that's going to cause issues with the financial system. So it's the tightening that's caused the issues. It always does. The question is, and the game that the Fed is trying to play, it's kind of like Russian roulette. What they're trying to play this game is saying, okay, maybe we got interest rates high enough that we hit this recession and we've got bullets in the gun. But I don't think they have enough bullets in the gun because this isn't going to be your normal everyday recession. This is going to be a monetary system change. It's going to be a big debt collapse. It's going to be de-dollarization, regionalization of commodity networks, all of those things. And so this time is going to be a little bit different. And I think people need to kind of hold on to their hats because I think it's going to be maybe quite a bit more scary than what we've seen in the past, just because we have this monetary system reset and all the uncertainty that has, and the fact that they're creating new laws as we go along, which I think means not everybody knows what their risk is. If you're a risk manager, how do you assess, how do you properly price assets in this environment? How do you mark to market? I don't know how you do that because I don't know what the system is going to end up being. We're changing the system itself.
Well, the large banks don't have to mark to market. The large U.S. banks don't have to mark to market. So if you're a regional bank, I interviewed someone who was Ted Oakley a couple of days ago, who was an investor in a smaller regional or community bank. And he said that all the securities his bank has to buy, they have to mark to market. Well, a large bank gets away with basically legalized accounting fraud. They don't have to mark to market. You talked about risk officers. I mean, like Silicon Valley Bank, they didn't even have a real risk officer. I think like if you look at her bio, it looks like basically a woke meme.
Well, yeah, that was part of the problem with that bank is a lot of the woke, if you want to talk about that just for a moment as a cultural phenomenon, a lot of that's sort of, I will say, spreading or infecting corporate America and the banks. And part of what we looked at Silicon Valley Bank was in making these goofy, woke, inclusive commercials. Their senior executives who, I don't know how much they make every year, $300,000 to $400,000. Think of what the bill rate was to make that commercial when you have all your senior executives doing commercials where they're tarred and feathered and they're doing these things that don't really have anything to do with business. It's more of a cultural phenomenon. And you have to think, okay, if you weren't, it makes sense. You weren't managing the business. You were virtue signaling. You were doing stuff like that.
They're wasting funds. Yeah.
Yeah. And that's wasting funds. And not only that, obviously, you point out the risk issue. I've been a risk manager before. When you don't have risk management in your business, this kind of stuff happens because this is where you're going to get caught by surprise that your assets are not priced appropriately and you're not maintaining your liquidity measures and you're not managing your business. So it's obvious that they were doing things that weren't, the primary function of the business. And the question is, how much did that affect it? Apparently a lot. And then the question is, how much is this going on across not only the banking system, but corporate America? If you look at the numbers around capacity utilization and efficiency, they're not great. Not only do we have a lot of people not working, I think it's like 38% of people, according to labor force participation, who could aren't. But our efficiency in our operations and our manufacturing, our GDP, our service economy is not great. And you have to think, is it all these regulatory goofball requirements around stuff like this and how much of waste is actually in the system?
Oh, yeah, I agree. And then they're going to force people. They're trying to force oil and natural gas companies. They're trying to force regular corporations like Bank of America. They're trying to, when they build a new corporate headquarters, they're trying to force all these ESG measures on them. So if they're going to force an oil and natural gas company to not invest in new oil and natural gas supply, I mean, we're going to have supply problems on the supply side for commodities for many, many years.
Yeah, commodity supply side is a major issue. It's something I've talked about on my program more times than I can count. We saw some of the supply chain problems during the pandemic because we tried to push button, stop the economy, and then start it. And obviously, our economies don't work that way. Most of the Western world followed Japan's just-in-time sort of system where there isn't slack, as much slack in the supply chain. It's something I learned in college when I took my operations management class for my bachelor's. There's not a lot of slack in the system. And so when something happens, it causes these slingshot effects where all of a sudden prices go up, you don't have enough inventory, and then they go down, you got too much. And right now we're too much inventory stuffing too much. But beyond that, the supply destruction that's been occurring on the commodity side, where for the last 10 to 12 years, we haven't gotten the investment into some of these explorers and development companies, and not only precious metals, but base metals, aluminum, tin, those types of things, copper, and the amount of demand that we need across the world to electrify and to build all these ESG programs would require so much more of these metals than we have in the pipeline. So at some point in time, if any of these ESG programs come to fruition, what it actually does, is what a lot of ESG people don't understand, it creates it moves forward an incredible amount of demand for commodities, because you can't have ESG programs without a shit ton of copper, a ton of silver, you need gold in there, you need zinc, you need for alloys, you need all that stuff. And we have not been financing the investment side or the exploration side for a lot of commodities for the last 10, 12 years, to the point at which we don't have enough. And you can't just push button, start a mine, and get what you need. The dollar is dead. Now, it's not dead right this minute, but you can tell it's over. The banking system is starting to collapse. Bond valuations are coming down. It was all a big bubble. Real estate's coming down. All of our bubbled assets are starting to come off. We're hitting a deflationary run. We're going to hit another deflationary run before the big one. We know that it goes in waves. But along the way, the world is figuring out this system is over. And they're not quite sprinting to the exits, but they're fast walking, trying not to be too conspicuous. They're building their own systems. They're embracing digital ledger technology in private cryptos. They're building their own wire systems. They're putting contracts in gold or different currencies. Previously, very antagonistic nation states towards each other are now coming together, and deals negotiated with our competitors. The market for United States anything is shrinking. The market for United States dollars is shrinking. The market for United States bonds is shrinking. The market for United States anything is shrinking, except for our energy and our natural gas. Europe needs that. But the market for anything US is shrinking. and the rest of the world is moving on, baby. They've already put their boats in the water. They're pushing forward. They're building their own infrastructure. And that's why gold and silver have risen. You would think that gold and silver would have risen right after the bank crashes like this. But I think what this is a capitulation of the market saying, after we looked at how deep the issues were and the banking collapses that we just saw, oh yeah, it's time to go back to gold and silver. And I think, we are now at a new plateau where gold and silver is going to move up. Now, it could come back under these numbers very quickly, but I mean, in the long term, it's not coming back under those for quite some time, for any length of time. I think it's going to continue to go up because we're going to see this news come out and people know you can't necessarily go the dollar and the US bond this time because that's what's collapsing. So the precious metals are going to get more of a bid. The cryptocurrencies will get more of a bid as well. And Bitcoin is coming back just like I thought, and Ethereum and all of those as well. We'll continue to watch that. That's going to be it. This one was just not heavy research, just my feelings about what's going on and a realization today more than anything that it's the end of the US dollar. It's finally over for all intents and purposes. Yes, we have another few months or a couple of years left in its current form, but it's out. And the world has moved on from the US as being the dominant anything anymore. Political, cultural icon, trading partner, reserve currency of the world. It's all over. It's done and over today. That's what the realization is. And that's why precious metals are going to do well. And they're basically going to be one of the only safe places you can go to when the stuff finally does hit the fan, which I don't think is that far off. Probably going to happen a little bit faster than I thought, and a little bit faster than the authorities probably were ready for, judging by their reaction to the recent bank collapse. Anyway, that's my view on things. Thank you guys so much for joining the channel. Until next time, this is 𝘺𝘀𝘾 with Gold and Silver Pros.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.